Good afternoon, everyone. You're all very welcome to Tuesday's US Market Open. Apologies, I'm 2 days ahead of myself, or behind myself this week. So obviously today we're going to be looking at the major teams in the markets. We talked about it last week, that inevitable sell-off that came off the back of the FOMC that very much kind of springboarded into the end of the week. Since then, and off the back of the Bank of England interest rate meeting as well, and the BOJ on Friday, we have seen that stock market weakness very much continue to the downside. You're even seeing articles as of today and yesterday on Bloomberg whereby hedge funds are cutting their risk in riskier stock market indexes, not just tech, but similarly across the board. That is having a very, very clear articulated move in the sentiment in the markets, because we're seeing that dollar escalation in terms of risk safety. We're seeing the dollar strength continue to be quite exuberant in the markets. And of course, both in Europe and also in the US, we're seeing the stock market indices really continue to progress to the downside. And that's exactly kind of where we are this week. And as I said, the best place to really start off is the risk aversion, that safety play, the higher yield story. We talked about it last week. That really stronger DXY is something that we're really seeing pinpointed this week. We're seeing that kind of gradual grind higher in dollar strength. Has been so really since the end of July, but over the last week or so, off the back of Fed, Bank of England, 6 interest rate meetings last week, we are still seeing that risk preserved to the upside at this present time, which is meaning that there's a much stronger want or desire to hold risk safety assets, hence the reason why the indices, the stock markets, are predominantly on the back foot this week and last week. Now, other things to really point out this week, as I said, in terms of the market dynamics before we look at the economic calendar, is obviously seeing that shift. So last week as well, we talked about the bonds, but something that we've been kind of very, very vocal at over the last number of weeks and over the last number of months more broadly. We're also seeing that yield story continue to play out, breaking through that 4.5%, highest point it's been now. We talked about last week since 2007. If you want to go even further to that to get exact dates, you're talking the autumn of 2007, which is showing that overall the exuberance is still very much there for a want and desire in terms of much higher yields. We've gone from a very, very low yield environment up to now just over 4.5%. So that's also fueling this kind of risk aversion play in these markets, where we're seeing that stronger dollar. We're seeing stronger yields. Yes, we're seeing weaker movements in a lot of the G7, G10, G20 currencies, but we're also seeing it in the stock markets, which is very much getting hammered. Got initially hammered in August. We got a little bit of a pullback towards month end in the stock markets, but in September we've seen that escalation in downside price action in the stock market indices, and that's something we'll obviously be looking at very, very shortly. So, looking at the economic calendar. So last week, we obviously had 6 central banks. We have a lot of central bank speakers now because the blackouts obviously ended. The central bank meetings have finished. You're going to have a lot of commentary from different individual central bank speakers over the next number of weeks, of which Neil has alluded to in his email this morning. Overall today, overall this week, we're probably not seeing too much in terms of actual technical or actual data pieces. There is obviously sporadic pieces here and there, but overall there isn't as much data, or we're not having as data dependent week as we did last week. Although that doesn't mean that we're not going to get the volatility. It just means that the kind of the trends that have been created and been set over the last few weeks are more kind of fulfilling its movements, is continue to grind in those directions. Now, today we have consumer confidence, we've got new home sales, which is obviously going to be something that's going to tie back to inflation, and we've got Bowman speaking at 6:30 tonight. Tomorrow, Wednesday, we've got the durable goods orders. We've got some basic European data in Germany. Thursday, we are expecting again to be the busier trading day of the week, because we've got a lot of data out in Europe. We've got European data, we've got German data, and of course, we've got US-based data, both sides of the open. So, of course, on Thursday, GDP is going to be a very much interesting data point. Now, of course, this week, the 26th of September, we are obviously going to have month end on Friday. So that's going to affect volatility in terms of redemptions, in terms of funds, hedge funds, institutions, and of course, all of the option and future traders as well in the derivative markets. So that's obviously quite important to play out this week, but we are still seeing these broader trends very, very much continue to play out. Now, if we look at the S&Ps, firstly, just to kind of give that broader directional bias, the S&Ps from last week, there was some of us short off the back of the FOMC last week. Some of us, I believe, are probably still short. The S&P really did kind of excel into the weekly close. We've seen it pause initially yesterday, but we're seeing that follow through today again as we approach 4,300 in the spot markets, the CFD markets. We're up around 4,350 in the future markets as well. So where we were last week, we were up around 4,500 in future markets. We're now down at 4,350, a nice 3 to 4% correction. And effectively what we're seeing here very, very visibly in these markets is a very meaningful correction off of what's been a very, very aggressive first half of the year. We looked at it last month, that aggressive movements through March, through April, through May, finishing Q1, Q2 very, very strongly. The first half of the year very, very strongly. We're now getting those cyclical retracements coming back in, profit taking coming back in by hedge funds, and we're seeing a little bit of an evening out in I suppose sentiment firstly, but of course also the actual physical price action and sentiment from an institutional perspective as well. We're talking about 4,300 now coming in on the spot markets. I've been a big advocate of really kind of seeing, could we get a decent retracement back into the kind of the 4,150s, 4,200s? Well, I think today, if we can see today, tomorrow, Thursday, if we can see that 4,300 level really break down into month end, I think you're going to have that trend play out over the next, as I said, next week or so. So worth keeping an eye on that one today. Indices very, very much on its derriere. Indices struggling, broadly speaking, very, very heavy selling last week, most visibly really off Wednesday into Thursday, but then it got a springboard really into the weekly close as well. And you can see that there, very, very clear, quick selling Thursday, followed through on Friday, new lows being created on Friday for the month of September. And of course, that's bringing in even further bearish sentiment into these markets. Now, I think at this point in time, if you are, let's say, on the fence, looking to engage into these markets, well, I suppose the best thing that you can do at this moment in time is trade with the trend, right? Because like there's no point trying to catch a falling knife, a falling piano, because of course, as the markets are continuing to decline and descend lower, unless there's a very, very clear observation that the sentiment is waned, the sentiment is past, and we're now in a period of consolidation or respite, then what you're effectively doing is you're buying in at a level when it's most likely going to continue falling. And you can see that very, very clearly, aggressively into the 4,300s into Friday. We saw that catapult lower yesterday. All it's a case of, it's creating short-term retracement, short-term pullback. So the logical scenario is now is, well, if we are creating a short-term pullback, short-term retracement, making sure that that momentum is ended, and then you're catching the next phase of price action. Otherwise, as you said, you're going to be catching a low, and then it's going to just continue dropping, and then you're going to be left licking your wounds, which is something you want to ultimately avoid. And that goes across the board. So whether it's the S&Ps, the NAS, the DAX, Euro Stocks, Dow Jones, it's a very, very centralized theme of what we've been seeing over the last week and a half or so. And it's also very, very visibly in the more riskier assets like the NASDAQ, because we talked about it last Tuesday, how the NASDAQ had made new lows into August. We got that lovely little retracement back up into the 500s on the NAS, but there was always that potential that the NASDAQ was going to repeat what we talked about in the FTSE, where we had that recovery, second recovery back up, failed to make new set of clear highs within the price action, within the sentiment, within the liquidity within the markets. And then, of course, we then ultimately tail lower. And of course, last week, the Fed, Bank of England was the catalyst. We saw very, very, very clear breaks last week from that 200 level, 300 level, and ultimately continuing to decline. And from last Wednesday, last Thursday, we're a more modest kind of 600-700 points. And that is a lot. In the NASDAQ percentage terms, you're talking 5-6% in a week, which is over 4, 5, 6 trading days, is quite a lot. Now, as we speak at this moment in time, the same principle applies with that of the S&Ps to that of the NAS. Unless you're getting any sort of kind of clear retracement, trying to source value is one of the hardest things you can do when the markets have declined so much, because then you're trying to find, well, where is my optimum entry? Where can I find relative value? And I think it becomes the kind of the nuances with trading to try and find or source that value. You can either try and scalp and run it through and make your trades as risk-free as quick as possibly can and try and run those shorts off momentum based, or you can try and wait for retracements, wait for pullbacks, and then catch the next wave lower. And they're really your two options to kind of navigate in terms of these types of market moving environments. And that's really pivotal because, of course, as you look at the NAS, Friday, short-term pullback, new lows. Monday, short-term pullback, back into the lows again. So you're really just observing kind of value. Yes, of course, we've got a 2-day area in terms of volume profiles, but overall, other than that, on the NAS, very, very little is holding this on here unless we potentially make another break today. And I think that's going to be the big point of interest today, to see whether the NAS can create another bearish close. Can we get that selling to continue? Because, as I said, what goes up must come back down. You only have to look at how aggressive these indices. When you zoom out, you get a bigger picture, you get a bigger scope of price action developing, and then you can separate the wood from the trees, as we say. And then the similar scenario is with the NAS, moving from the NAS into the Dow Jones. The Dow Jones has been probably the less aggressive of the three through the course of the year. The S&Ps has held up very, very well. And the NASDAQ traditionally phase Q1, Q2 done very, very well. We're still seeing the Dow Jones labor, like with the other two, seeing a more meaningful correction. We've broken through the August lows in the Dow Jones. NASDAQ in comparison is just holding on. S&Ps in comparison has just narrowly broken through. So you can see that when you compare the three like for like, you can still see that the Dow Jones is definitely the weakest of the three. Now, again, centralized team, this selling narrative that we've seen is no different. We've had that peak formation in July, very, very clear correction. We're back down into the 600 handle, 800 area, 6 to 800 level here. That's really going to be the key area this week, because of course, if 6,800 gives way, you're really looking at then high 32,000s, low 33s. You're going to bring in probably another 400 to 600 point movement of further declines coming in this index, because of course it's migrating against the order flow. This is where the previous run ended of selling, way back down at 32.8, just below 33,000. Then we got the peak all the way up into the highs between 400s, 34,000, 34,200 and 33.8. So of course, logically speaking, if the price action can continue the sentiment, break through the 800 levels, you really should be looking at least another kind of 300-400 point conservative runoff in terms of mitigating the price action. And that is something that's very, very ominous in these indices at this moment in time. Now, we've just gone to 2:30. And before we kind of look at the market profiles, short-term timeframes for the day, NASDAQ is struggling at session lows. S&Ps is also struggling at session lows. So 43.10, 43.12 on spot. NASDAQ around 14,650, 670s is holding up relatively well. The Dow Jones is again at session lows. It is holding at 33.8. So I think the logical scenario there is if 800s gives way, you're probably going to bring in selling. If 650 gives way on NAS, it's going to bring in potential for selling. And similarly as well, 43.10, 4300, if that gives way, you're probably going to see further selling coming through in the indices. So they're your kind of benchmarks for pricing, estimating and kind of understanding value within these market conditions. If you want to bring in profiles as well as like as an additional confluence, just very, very, very quickly, I suppose the first thing we got to look at is where is the volume profile for the day? Well, we know that the point of control is at 20s, roughly speaking. Yesterday, we had a little bit of up and down in a bell-shaped curve. A lot of the volume was also contained around this 20 region. So that's going to become an area of value for today, tomorrow, really estimating how does the price actually act. Because of course, anytime that we've gotten above the 30s levels, it seems to have faded. We've seemed to come back down into the 4300s, 4310s, 15s, etc. So that's going to be the point of interest today, is just to really see how does the market dynamic fare out, particularly in that first 30 minutes. Yes, we know indices are at session lows. We're holding up relatively well in the open in the first 4 minutes. NAS is holding up just about. Dow Jones is holding up just about as well. So I suppose that's really going to be the pivotal point, is to see how does the price action hold up in the first 30 minutes, because of course you're watching these areas very, very, very closely. And of course, with the S&P going across to the NAS, you'll see very, very, very clear structure. 700s gave way, clear bell-shaped curve move into the 650s to where we're currently at. That's really your benchmark lows there yesterday around 625s. I think 600s gives way, that continuation of selling goes, then it's probably going to bring in more selling. If you're looking to try and find value, the value play rather than, like, let's say, the momentum play, then you're going to be looking for opportunities up here around the 700, 710, 720s from a point of control level. Now, where does that leave us on the day? Well, that's pretty much around session highs for the day. So that's obviously something to look at. Really, overall on the NAS, if you look at the NAS, very, very, very choppy price action, very, very up and down. Yes, the broader narrative is still very much bearish for the indices. We are just about holding on. So it's all about, again, trying to ascertain value and just making sure you're doubling down on those confirmations, particularly given the fact that the NASDAQ has sold off, as we said, how many 100 points since last Wednesday. I think we're talking about 600-700 points. So that's just important to kind of have in the back of your mind at all times. Now, similarly with the indices story, with the DXY story, the yield story, you also have to look at the FX side of things. And we've seen, I think, the best example of this dollar strength, this risk aversion play, is in cable, right? Because you look at the pound dollar. Last week we had obviously the Fed, we had the surprise the surprise movements again by the Bank of England, and we've seen that pound just continue to chug lower. That aggressive grinding selling bias is very, very much continue to play out. It's not too long ago, and I was a big advocate of seeing, well, if the Bank of England continues raising its policy, raising its hikes, we should be looking at 133s. We should be looking at 132s. Yes, we got to 131s. And then all of a sudden last week, out of nowhere, change of policy. They went from aggressive hiking policy with an overwhelming majority of raising rates to only four members last week opting for a hike, which of course is bad news for the pound. You're seeing that underwhelming price action move lower, and that's exactly what we're seeing. And since last Wednesday, since last Thursday, institutional pricing is very much forecasting now weaker GBP USD dollar pricing, and would not be surprised now to see this really continue to grind lower into the low 120s. We're just below 122 at the minute. Wouldn't be surprised if we saw 120 again in the not so distant future, maybe over the next week or so. Gold prices is also very, very similar. Gold last week was very, very, very choppy. Since then, again, that stronger dollar play has very much seen gold coming back into that 1900s. Last week or so, 2 weeks in particular, very much gearing back and forth between the 1900 lows, the 1950 highs. We've seen reactions both sides from the lows, from the highs. So there's very much kind of a containment within the price action. That is very much given way. We're seeing the price action expel and progress lower. And now it's really just a case of, well, does the 1900s actually hold up? Well, we saw it on the 15th September, the 1900s held up very, very well, but that does not necessarily mean that we're going to come even lower. Break through the 1900s, have a pop at these lows from August, and then try and progress even lower than that in these markets. So that's effectively where we are. We're still seeing that dollar strength story continue. We're seeing the yield story within the bond market still remaining quite resilient. We're seeing gold prices at or close to month lows. We're seeing euro dollar cable prices continue to grind lower. We're seeing dollar yen continue to pick up, of which now dollar yen is trading at 149, back to where it was around about 10-11 months ago when we started to see the BOJ getting involved. And you have to go out to a higher time frame on dollar yen to even see that. Of course, I can show you this now. Dollar yen trading really where it got its involvement last October, last November by the BOJ, where it started to move on its yield curve. And all of a sudden now we're trading back into that region again. So that's really risk orientation is very much risk off at the minute. We're seeing indices lower. We're seeing market conditions very much lower. So that's why just be kind of careful with that. I think as day traders, obviously we're looking at the shorter term perspective. So we're less kind of engaged on the higher time frames. But when we're seeing big moves like what we've seen over the last 3 or 4 days or so, it's definitely no harm to look at the bigger picture just to get some perspective of where we actually are within, I suppose, sourcing fair value pricing within these assets that we're currently trading. And that's really something that's very, very important at this moment in time. Now, I suppose last but not least, just rounding off today's call, which is probably a little bit of a longer one, is the European indices. And we talked about it last week. The DAX, the Euro stocks, was very much contained, 3-4 month ranges. 15,600, 15,800 was kind of your lows on the DAX. That is very quickly given way this week. So we're obviously with that stronger dollar, the risk aversion play, we're seeing risk assets. Like we said, the European indices are no different to that. they are moving lower as well. We've popped through. We're now sitting, I suppose, 2% lower than really where we were in last week in the DAX, moving lower. We did mention the 200s. I think last Tuesday night's webinar call, we did mention the potential for that really to break down, progress into the 200s. It very much looks to be on the cards. Euro stocks, very, very similar. 4200s, 4250s was the progressive lows that we've had for the last, not just last week, but for the last number of weeks. I would even go even further to that to say months, and we've clearly broken through 4200s. This week, the progressional downside is still very much waning. And of course, not too surprising when you look at the bigger picture, right? This is where we were last September, last October, a very, very aggressive move in European indices. It certainly looked like the idea of buying indices now, particularly Europe, is done for the year. European indices looks like it's probably going to continue suffering, and that's really more focusing on DAX and the Euro stocks. If you look at the FTSE, obviously the FTSE had that aggressive move higher into 77s. We came off 77.50 last week, of which I'm currently short. We are seeing a little bit of a short-term bottom being created around 76s. I would look for kind of another reaction around that 76.60, 76.80, 7700, see if there's another kind of propulsion of further selling bias in there as well. We're definitely seeing it in Europe with the DAX, with the Euro stocks. We're seeing it in the US as well. Last week, S&Ps, Nas, Dow Jones. We've got month end on Friday, volatile day on Thursday with decent volatility. Let's see how these markets react. And of course, all in the face of that, we've got more central bank speakers as well. All right, so that's pretty much where we are. I'll be back later on for a webinar tonight, everyone. So we'll catch you all later for a deeper dive into the markets. All right,